Are you running a trading business across borders? Maybe you're sourcing products from China, then selling to customers in the US, Europe, or other markets around the world. And your profit margins are not where you would like them to be. Bank transfer fees, FX commissions, and taxes all eat into your revenue. What if there was a better way to structure your business and keep more of your profits? Hi, I'm Bertrand, founder of Statrys, and in a previous life, I was involved in sourcing goods from Asia. So in this video, I'll show you how Hong Kong re-invoicing structure works. I'll also explain how you can potentially reduce your corporate tax to 0% using Hong Kong offshore exemption. And finally, I'll demonstrate how modern multi-currency business accounts help you stop losing money on fees and conversion. So let's dive in. The business model for trading physical products is simple. You buy at one price and sell at a higher one. Very simple. But you may face two core problems that are hurting your profits. The first problem is operational. You need to pay suppliers in China or another Asian country, possibly in their local currency. But trying to make those payments from a bank account outside Asia can quickly turn into a nightmare. The processing times alone are long and unpredictable. But the worst of all, banks often flag or block this transaction entirely. They see your payment to Asia as a high-risk transaction. This slows down your entire supply chain and can damage your supplier relationship. Second problem is financial. Even if you get the money moving, you're getting destroyed by cost. Transaction fees are high, but they're not the main issue. What really eats into your margin is the high commission your bank charges on currency conversion. And after all that, the profit that finally lands in your home country bank account get hit with high corporate tax rates. So how do you fix this? The key is to create a company in Hong Kong acting as a re-invoicing center for all your international transactions. The concept is incredibly simple. Here's how it works. Your supplier in Asia sells product to your Hong Kong company. Then your Hong Kong company sells those same products to your end customers in the US, Europe, or elsewhere. The goods are shipped directly from Asia, where your supplier is based, to the country where your customer is located. They never physically touch Hong Kong. But the invoices, the paper trail, and most importantly, the profits are now legally centralized inside your Hong Kong company. So, why are so many international traders using this structure? Because it instantly solves both restrictions we just talked about. To make this work, you need two things: a Hong Kong company and a business account that can handle multi-currency transaction. And here's where it gets interesting. You can set up both with Statrys, Game Changer. Other fintechs either offer one or the other, company creation or business account. But at Statrys, we do both to create a smooth experience for our clients. Imagine this. Your customer in the US pays in US dollar to your Statrys business account in Hong Kong. Then you pay your Chinese supplier directly in China, possibly in renminbi, while avoiding the hidden fees or terrible exchange rates. Just clean, simple, multi-currency cash flow. Now, for the best part, the potential tax benefits. Hong Kong operates on a territorial tax system. Here's what it means. They only tax profits generated from activities inside Hong Kong. For international trading businesses, your activities are happening all over the world, except in Hong Kong. You're finding suppliers in China or elsewhere, you're negotiating with buyers in the US, Europe, or elsewhere, and you as a director might be living in Thailand, Dubai, but not in Hong Kong. Because your co-business operation, the buying, the selling, and managing are all happening outside Hong Kong, you can apply for what's called an offshore profits tax exemption. When this is approved, your tax rate on profits becomes 0%. But here's what you need to understand. Offshore exemption isn't automatic. You have to apply for it and prove that your profits truly come from offshore activities. Reality is not a big issue if everything is set up correctly. Check out our video on this. Now, the first question everyone asks, this sounds too good to be true. Is this actually legal? Let's be clear on this. For the Hong Kong company itself, the answer is yes, 100%. Getting 0% corporate tax through the offshore exemption is completely legal and written into Hong Kong's tax law. However, what needs to be checked is your personal tax situation. This becomes critical when you withdraw funds from your Hong Kong company as salary or dividends. Some international tax regulations may apply, like double tax agreement, control, foreign corporation rules, common reporting standard requirements, or transfer pricing. Sounds a bit complicated, right? So the specifics depends on your citizenship, your tax residency, and where you're physically living and operating the business. This is where you should consult with qualified tax professional. Because remember, you're not just setting up a company, you're building a system that has to be compliant on a global level. So, if you're an international trader ready to explore this structure, visit Statrys.com and click Get Started. At Statrys, we help foreign entrepreneurs with our full suite of services, from incorporating Hong Kong companies and setting up business accounts to ongoing accounting support. Our process is fully online and by dedicated account managers. Have questions? Reach out via live chat, WhatsApp, or email us at support@statrys.com. Thanks for watching. Have a good one. See you next time.